the way. Basically, were you in the last free session I organized for those in on the group, on the Telegram channel?
Yes, I attended. I came in. I'm sure I came in late.
Okay, so we're going to start from there because, like I told them in that particular session, market structure is the foundation of technical analysis. It's like the is the structure on which is the basics on which technical analysis is built. So it's like is the simplest thing you can learn for you to start building on when it comes to what technical analysis. So for our first section today, we're just going to look at market structure. And I'm sure it's not something that is alien or new to you, but
Yes.
we'll just go over it and then we'll build on that. So from market structure, we'll go over to how to, maybe our next session, we'll look at how to map out key zones. So because once you're able to recognize the structure of the market, you can mark out your key zones. You've solved 50% of technical analysis. Every other thing will just be what addition. I know of people that they use only market structure, just the knowledge of market structure. They make money. Why? Because they know that when it is going down, we are selling. When it is going up, we are buying. When it is ranging, we are staying away from the market. That's all they do. So basically, market structure, if I'm to give a simple definition, is is the structure of the market on the chart that shows us the relationship between the buyers, the sellers, and the price of the assets we are looking at. So I'll just put it simply again. So market structure simply shows us the relationship between the buyers, the sellers, and the price. So when we open our chart and we see a structure of the market going down, perhaps something like this, it simply means that the relationship of sellers with the price is stronger than that of buyers with the price. Do you get what I'm saying?
Yes, sir. Yes, sir.
So if we have it the other way around, and then we have something like this, and the price is going up, it simply means that the buyers have a stronger relationship for price as compared to what sellers. So what this simply means is that buyers are okay with price, so they love it, and then the price of the commodity will keep what's going upwards. Now, also sellers, when they are okay to sell, irrespective of how low the price is, then that means the price of the commodity will keep what's going down. So that's my own simple definition of what market structure. So just as I've used in this example, there are two basic types of what market structure. We have the downtrending market structure, also referred to as what the bearish market structure. Then we have what the uptrending market structure, referred to as what the bullish market structure. And then of course we have the consolidating or ranging market structure, which is a structure of the market in which price moves in an horizontal direction. When we say horizontal, it means that market is neither going upwards, neither is it going what? Downwards. Now, these are the three basic types of market structure that we'll be concentrating on. And the way I take my classes, after every session, I give you an assignment which you send to me on WhatsApp, and then I'll know if you grasp whatever we've talked about or not. So let's look in depth at these three types of structures. First of all, let's look at the bullish market structure. Now, we say that the market structure is bullish if the price of the asset or commodity is making consecutive highs and lows. In other words, when it is making higher highs and higher lows. So the thing is, what do we mean by higher highs and higher lows? So if we have a market moving in this manner, so the market creates a high and it comes back to create a low. We call this a high, we call this a higher low. Why are we calling it a higher low? It's a higher low because this is the low that started the market. It gave us a high. The fact that this low is higher than this initial low, we refer to it as what? A higher low. Now, when this low goes ahead to create a high, we call this a higher high because it is higher than the most recent high or the most previous high that was created. So this becomes what? A higher high because it is higher than this. And then when it comes back to give us another low, because this low is also higher than the most recent low, we call it what? A higher low. So in that case, we say an uptrending market or a bullish market structure is one in which price of the asset creates a series of higher highs and higher lows. So we have higher highs and then we have what? Higher lows. So the question now is, why is this important to our trading? Remember, I just stated earlier that I have friends that trade only market structure. So that means when they are able to recognize structure like this, going upwards, and uptrending market structure, all they need to do is that, first of all, this market gives them a basic information that we can only buy in this structure of the market. Then the next thing they now look at is, where do we buy in this market? So I always tell people that when you're looking at market structure for an uptrending market, the most important areas in an uptrending market are usually what? The higher lows. Why? Why are they the most important areas? Because those are the areas where you can buy and get a good price. Now, what do I mean a good price? It means you know generally that when it comes to your regular buying and selling, you want to buy at a price as low as possible. Am I right?
Yes.
So even when you go to the grocery store, you might see maybe different brands of maybe milk, and then you look at them that, oh, they probably give the same value, but you would want to go for maybe the cheaper one that gives, or you want to buy at a cheaper price. And this thing I'm saying now is the reason why you have things like Black Friday. I'm sure you've heard of Black Friday.
No.
Okay, Black Fridays, they are usually days or times in the market. I'm talking of general market now, not just forex market. There are usually times where sellers, they give discount prices. They'll tell you that Black Friday they're giving 50% discount, 20% discounts. Now on those days, you see more people going to buy compared to the regular days. Why? Because people want to buy at prices as low as what? As possible. So if we are to relate this to our technical analysis, now we say that these areas are what? The higher lows. And these are what? The higher highs. Right?
Yes, sir.
Okay. Now, the advantage of knowing this, of having this knowledge of market structure when it comes to an uptrending market, is that it helps us to understand that if we are to buy, we should always wait for price to return to the what? The higher lows. So if I'm to take this up, so this price was moving upwards, it gave us a high. So people bought here, and then the price went up. Now, the essence of understanding market structure is having the knowledge that every time price goes up, it always does a retracement downwards. So as a buyer of the market, when you see an uptrending market, once you see the price of the market going up, it is not the time to start buying. So with this knowledge of market structure, you would always have it on the back of your mind that, oh, once price has gone up, a lot of people will start jumping in because they don't want to miss out. Why you? Because you have the knowledge of market structure, you just know that I have to stay calm and wait for price to do what? Retracement. Because you know that in an uptrending market, once you have a higher high, you will always have what? Higher low. So the knowledge of market structure, or knowing that this is an uptrending market, will always make you wait that even if price has gone up, you are confident that price will always what? Come down at some point. So what do? You always wait for this price. You always wait to engage the market only when price comes down in an what? Trending market. So we say that in an uptrending market, we buy at the what? Higher lows. We do what? We buy at the what? The higher lows. So when market makes a higher high, we wait for it to come down and then engage the market. So that's that for what? An uptrending market. So for the downtrending market, we say that a market is in a downtrend or it's in a bearish form if it makes a series of lower lows and lower highs. So we have market making lower lows and lower highs. So we say this market is in a downtrend. So we have this, the market was in a high, it gave us a low, and then of course it gave us a lower high. Now, why do we call this a lower high? sorry, rather, yeah, it gave us this. The market gave us a low, gave us a lower high. We call this a lower high because even though this level is lower than this, let me use this. Now the market gave us a low. They made this move. We call this a lower high. Even though the market is higher than this level, it is lower than this level. So because it is lower than this level, we still call it, though it is a high, we call it what? A lower high. Am I making sense? Hello,
Yes, sir.
patience. Are we still together?
Yes, sir.
Okay.
No, I'm following up.
Okay. So now the market from this lower high gave us what? A low. Now, because this low is lower than the most recent low that the first level gave to us, we call this what? Lower low. So we have low, lower high, lower low. And then this gives us another what? Lower high. And then because we say this is still a lower high because it is, though even though it is lower than this level, but it is higher than what? This level. This becomes what? A lower high, lower low, lower high, lower low. So anytime we see a market making this move, we say that the market is in a what? A down trend, and we can easily put what we call a trend line. So, excuse me. So we can always include what we call a trend line. So a trend line is simply a bounding line that helps us to know the direction of a market. As time goes on, we'll probably talk about trend line when we're talking about our key, how to map out key levels. So now we have a downtrend, an uptrending market, a downtrending market. So remember, in the uptrending market, I said the most important areas are what? The higher lows. The downtrending market, the most important areas are the what? The lower highs. Now, why are they the most important areas? Because just as buyers want to buy at a price as low as possible, sellers want to sell at a price as high as possible. Am I making sense?
Yes, sir.
So just as the buyers, they want to buy at a price as low as possible, the sellers, they want to sell at a price as high as possible. So let's look at this closer. Somebody sold here, let's say this was 10 in Cameroon, you guys use cephas, right?
Yes, sir.
Okay. So if somebody sold something at 50 cephas, right? And because the person was selling at 50 cephas, a lot of people went ahead to keep buying from this person. And as a result, the price went down. Or a lot of people could not afford 50 cephas, but this person sold at 50 cephas. Let me put this. The person sold here, let's say this is 50 cephas. The person sold at this price. And then because a lot of people could not afford it, the price of the of this particular let's say fuel started going down, right? And then the price went as low as, let's say, 25 cephas. And the people kept buying and buying and buying. So the people kept selling. At some point, because the price has fallen to 25 cephas, some sellers would say that if somebody can buy this thing at 50 cephas, I'm not going to sell my own at 25 cephas. I'm going to wait for price to come up a bit. If somebody can buy at 50 cephas, then that means somebody can probably buy at maybe 40 or 45 cephas. Am I making sense?
Yes, sir.
And that's the reason why we have what? A lower high. So at some point, price cannot just continue going downwards. Price would at some point pull upwards before continuing downwards. So sellers would always want to sell at a price as high as possible. And they wait for this pullback and then they sell. So for us traders, when it comes to technical analysis, simple knowledge of market structure, just knowing that this is a downtrending market because it is making a series of lower lows and lower highs. What we need to do is to always wait. Once we recognize that this is a downtrend, irrespective of the time frame, once we know that this is a downtrend, all we need to do is to always wait for price to do a pullback. And of course, we have a trend line to help us understand where price is pulling back to. So we will know that once there's a pullback, we'll start looking for how to make our sell trade. So the last one is the what? Consolidating market or the ranging market. It is the kind of market in which neither sellers nor buyers have a stronger relationship with the price of the market. What do I mean? It's a market that moves in a horizontal direction. In other words, sellers are not in control, neither are buyers in control of the market. So we say that such market moves between a constant high and a constant what? Low. Now, the simple way to engage this market, most times I tell newbies that are just coming into technical analysis that focus on the trending market. In a consolidating market, stay away from it. But it is also good that you have a knowledge on how to trade it if need be. Because sometimes the market may range for a very long time, and if you want to stay away from it, that means you wouldn't be trading at all. So simply put, for a consolidating market, we sell at the upper part and then we buy at the lower part. And this upper part is what we refer to as what? The resistance zone. While the lower part is what we refer to as what? The support zone. Now, so in the consolidating market, we sell at the support, at the resistance, and then we buy at the support. And this resistance zone is also what we refer to as what? The supply zone, because that's where you have a lot of sellers supplying the commodity for people to buy. While the support zone is what we also refer to as what? The demand zone, because that's where you have a lot of buyers demanding to buy the commodity. So, am I making sense thus far?
Yes, sir.
So, are you following? Are you gaining anything thus far?
I'm following, sir.
So, at this
Yes,
point,
I'm understanding.
do you have any question before we move on to our chat?
No, for now I don't have.
Okay. So, the next thing that we're going to do now is to look at this simple demonstration now on the chart, because in as much as this looks pretty, on the chart is usually not this straightforward, because you have a lot of noise on the chart. I call it noise because they just try to put you off, right? So let's look at.
So let me just ask something.
Okay. Okay.
As you say, when the market is, let's say, a trending market,
Yeah.
the market is going up.
Yes.
Okay, if it goes up, then you don't buy. You say we should not rush in when the market is going up.
Yes.
And you are expecting the market to come down to pull back so that you go in. Yes, you should reach the trend line.
Yes.
If it does not come down, it continues up.
Okay. There's a theory called the Dow theory. Okay, let me not bug you with that. The thing is, for an uptrending market, that's where patience comes in. And most times that's what that usually is the difference between somebody who just started trading and somebody who has experience in the market. Now, when you have experience analyzing the market, over time you see that no matter how far the market goes up, it must always come down.
Okay.
There's no, if we go to the chart now, you can see that you have red and green candles, right?
Yes, sir.
So you can see even on the chart, it must come down. Now, all you now need to do is, do you have enough patience? So the reason why most people rush in is because of what we call FOMO, FOMO, the fear of missing out. It's because you are scared that, oh, but another thing that you also need to zero your mind on as a trader is that the market will always be there. So if you open your chart, maybe you are monitoring a particular trade and then you miss out on it. Yeah, all well and good, you've missed out on this particular trade. But know that the market will always be there. But if you rush in, your money might not always be there. Do you get? So there are lots of people that, because of rushing into the market, or they are scared they will miss out, at the end, they end up losing their money, and then the market still comes back down to where they would have bought or sold in the first place. Do you understand?
Yes, sir.
So does that answer your question? The market will always come down.
Yes.
Excuse me. So look at the chart now. So just mainly looking at the chart, you see that the market always gives you up high and lows. You see it will always go down but it must always come back up. It goes down, it must always come back up. So that's just the way it moves. It must always come down. So it's you now accepting that, oh, I've missed out on this particular trade, or I didn't get in on time, so I just have to wait. I've missed out on this particular one, then I have to what? I have to let it go. Okay. So back to what we just talked about. So we're going to look at examples of higher highs and higher lows. This is Euro USD. Let me do this on the 4-hour time frame. Okay. So now this is Euro USD. So from what we just talked about, if I'm to map out from what we just talked about, if I'm to take this trend line, you can easily see that this is what kind of market is this?
Uptrend.
Yeah. So this is an uptrending market. So because I have my trend line here, the trend line will help me towards the trend line helps to guide me. Even simply looking at it from the illustration I just gave with those diagrams, you can simply see that this is an uptrending market. So the major challenge most people have when they're starting out is to recognize the major highs and the major lows. Now remember that what I showed you on the demonstration was something like this, right?
Yes, sir.
So this looks straightforward, isn't it? But you can now see that on your chart. On your chart, it is not that straightforward. So your challenge or your challenge now will now be to recognize the major lows and the major highs. So I can take this as my low. It gave me a high, and then it went on to give me a higher high. This high ended up giving me what? Higher low. And then this higher low give me a higher high. I have a higher low, higher high, and then the market has given us what? Higher low. So you can see that this simple knowledge, now what would you be looking for here now? You'll be looking towards buy the market, right?
Yes, sir.
So you can see, just like I told you, each time the market goes up, we always does what? Always come down. We always what? Come down. So you can see, and just like I said the most important areas are usually what? The higher lows. So once you're able to recognize the higher lows in the market, so we can see here that we had a high, the market did what? It came down. So if we were to engage this market, we'll be looking for our buy options here. So let me take out the higher highs so that it will not be that cumbersome or too complex. So is it a bit clearer now?
Yes, it's clear.
So because we are not looking deep into analysis, I'm just showing you where to buy in an uptrending market. So we've seen the market structure. We have an uptrending market. Now we're applying it to how it helps our analysis. So each time you see an uptrending market, your focus will be on what? The higher low. So that means when the market moves, if you open your chart and the price of the market is here, you should not be interested in trying to click on buys. The focus would be waiting for it to what? To come down. And just like it did in this case, the market went up, it came down. Let me mark this. I missed one point. It came down. And then people bought. It went up again, and then it came down. People bought. It went up again, and then it came down. People bought. It went up. You can see now that it has come down the trend line. So this is our higher low. If I'm to go further down, I can now start looking for what? My entry here. So maybe before the end of today.
What if we buy? We buy at this point that it is down, then it goes down.
Yes, that's why there's nothing absolute in the market. But the thing is, if you buy here, before I start clicking buy here, there are things that I will have to look out for. We'll talk about those things when we're talking about entries into the market. Okay. Now, even looking at this now, I can even start thinking of buying this particular asset. Why? Because of this rejection candle that I'm seeing. Do you understand? But that's why also you have what we call what is stop loss. The stop loss is your safety net, because there's nobody, no matter how good you are with analyzing the market, everything could be right in your analysis, and then the market can still go against you. Do you get what I'm saying?
Yes, sir, I understand.
Yes, so that's why you have what? A stop loss. But the beauty of it is that if you have a strategy, that you are consistently using, that you consistently stick with, like you have everything that you're looking out for, even if out of 5 times you are wrong 3 times, you will still end up being profitable if you follow the rules. Do you get? So the essence is not, the essence of technical analysis or having a strategy is not to be right all the time. It's to be right most of the time, and for your being right, making you profitable. Does that make sense?
Yes, sir.
Okay, so now we've seen an example for the uptrending markets. Let's look for something on the downtrending market. Let's see if I can get something for a downtrend. Okay, so now in this case now, we have the market giving me what? A low, right? The market gave me a low.
Yes.
And then we have what? Lower high. The market comes back to give me a lower low. It comes up again to give me what? A lower high. Then the market moves down to give a low. The low couldn't take out this particular low, so we will not consider this. It came down here, and then we have what? We have a low, give us a lower high. We have a lower high. So you can see that each time the market came down, there was always what? A pullback. Each time it came down, there was always what? A pullback. Each time it came down, a pullback. It came down, a pullback, came down, a pullback, until the most recent lower high was what? Was taken out. So basically, just like we had for the uptrending market, we can as well include our trend line here and say that anytime the market does a retracement, we would what? We would sell. Does that make sense?
Yes, sir.
Okay. So lastly, let's look at the consolidating market. So like I said, the consolidating market is one which moves between support and a resistance, or a supply and a demand zone. Let's see if we can use this level here. So what I'm drawing now are what you can refer to as what? Key zones. So that's what we'll be doing in our next session. So now if you look at this market, you agree with me that it's moving between one level and coming back down to another level. This level comes back down to this level, goes back up and comes back down. So to simply engage this kind of market, all you need to do is to wait. Anytime price comes down to the support, you look for your entry criteria, you buy. And then because you know that it is consolidating, your take profit will be close to the what? The resistance level. And then once you take your profit, if you see that price fails to break above the resistance level, you sell, excuse me. And then you place your take profit close to the support level as well. And then once you take your profit, so people that also trade this, and then you see they just keep making money by selling at the resistance level and buying at the support level. So for our session on market structure, this is what it is all about. Like I said, it is the foundation of technical analysis. I would expect that you're going to send me an email address. So I recorded this session and I'm going to send you the video so that over time you can go over it again and again. And then if maybe because of the way the class is now, you're not able to spot or bring up any question, when you go over it, I'm always there on your WhatsApp. You can always send me if you have any questions, you can always reach out concerning any particular class. Is that okay?
Yes, sir.
So just a recap, we said market structure shows the relationship between the buyers, the sellers, and the price of a particular asset. So that we have 3 basic types of market structure: an uptrending or bullish market structure, a downtrending or bearish market structure, and a consolidating or ranging market structure. We said an uptrending market is one in which price of the market makes a series of higher highs, consecutive higher highs and higher lows. And we said that a downtrending market is one in which the market makes a consecutive series of lower lows and lower highs, while a consolidating market is one in which the price of the market moves in a horizontal direction between a support and a resistance. We said that for an uptrending market, we buy at the higher lows, and for a downtrending market, we sell at the lower highs, while for a consolidating market, we buy at the support and sell at the resistance. So, patience, I believe I've done my best to be clear as much as I can. So, if you have any questions, you can ask with the remaining time that we have.
But now I don't have any question. I've understood.
Okay, so that means I've done a good job in this first session.
Yes, sir. Very good job. I've understood.
So I'm going to stop it now. I will send you this video. So our classes will be every Tuesday by this time. I hope that's okay.
Okay, it's okay by me, sir.
So the assignment you're going to do for me, you're going to open the chart. You're going to open the chart. First, you recognize a downtrending market. You recognize an uptrending market. For the downtrending market, you are going to mark out the higher and the lower highs, just like I did now. Is that clear? Then for the uptrending market, you are going to map out the higher lows. And then for consolidating markets, you are going to map out the resistance and the support, just the way I drew it now. And then you send me a screenshot of each.
Okay, sir.
That okay? So you send me a screenshot of each on my WhatsApp. I'll look at it. So in our next class, we'll review whatever you did, if you did it well or not, before going to the next lesson.
Okay, sir.
Okay, so do enjoy the rest of your day, patience.
Thank you. Thank
So
you so
send
much,
me
sir.
an email address that I can send this to.
Okay, sir.
All right, take care.
Thank you, sir. Thank you so much.
You're welcome.